Hi there, welcome to our CRMBC video series. Today we're talking about assessments. My name is Kaya Stanley, and I am the chair of the board and also the CEO of the California Restaurant Mutual Benefit Corp. Today I'm here with Mike McDonough from McDonough Insurance, and he is also the broker liaison for CRMBC and the author of this amazing book, The Employer's Guide to Workers' Compensation, in which he's sharing 70 different tips on how to save money and increase your profit by managing your workers' compensation program in your business. Hi, Mike, welcome.
Hi, Kaya. How are you doing today? Thanks for having me. I'm grateful to be here and look forward to our conversation today.
Thank you so much. So in self-insurance, there's a couple of things that are unknowns that scare some brokers and scare some potential members. And so we want to just dive right into those and talk about those really head on. The biggest one is the idea of assessments. So I want to just start with, what is an assessment? As we know that assessments happen just in any system, not just in self-insurance. If you don't charge enough up front, then later you have to assess to collect what should have been charged at the beginning. So give me a high-level overview of what is an assessment.
Well, in simple terms, an assessment is basically collecting enough money to offset your expenses. And so in workers' comp or in a self-insured group, sometimes there's unexpected claims development. And this is normally discovered when an audit is done and we determine the amount of contributions coming in compared to what the potential claims development could be. And so what the state will say to us is that, hey, you need to get your assessment up. I mean, you need to get your cost to cover the claims up. So you're going to need to have an assessment. So an assessment is just ultimately just asking the members of the group that we're going to go and we're going to assess each member based upon your time in the group, the size of member you are, and so forth. And basically, we're just collecting premiums that we should have collected maybe a couple of years prior to. So as far as from a cash flow standpoint, that's money that you didn't have to spend or contribute, and now they're going back and asking for that. And compare that to a traditional carrier. If you start having claims and you get an experience modification, and let's say your mod was 70 and now it's 150, that's an 80% assessment right there as well. So you can look at it as an increase, you can look at it as an assessment, but in reality, it's just collecting dollars in order to cover future losses.
So some people who are looking at self-insured groups think that an assessment is a penalty, but clearly it's not a penalty any different than your rate being raised due to an X mod.
Correct. So if we have an actuarial study based upon our claims, and then all of a sudden those claims, depending on the economy we're in, we're getting more post-termination claims as an example. So when the economy is in a situation like we are now, you may see a lot of layoffs. What that does, that generates a lot more workers' comp claims. So if that wasn't forecasted based upon our known losses, then what the actuary is going to say, hey, if we continue on this trend, we may need more money to offset these claims. So what we're having you do is go back and assess your members to get this up so that we can cover any potential future losses. Now, the benefit to that is that even though there's an assessment, we may not use all that money. And then in turn, what the group will do is refund a portion of that money back to you. So an assessment is not a penalty. It's just asking for dollars to pay for potential future claims. And that's understood when you come into the group. So it's not a penalty. It's just keeping the solvency of the group. And it's a collective effort by all members that everybody understands that if we get into a situation unexpectedly, that we have enough to cover our losses.
And when making a determination whether to join a group like this and taking into account the potential of an assessment compared to the benefits of self-insurance, to me, it's just, there isn't even any comparison. And as you know, CRMBC had an assessment over 12 years ago, and it turned into a time for the group to completely revamp and turn around every single aspect of the group, to get rid of some old service providers, bring in new service providers, really shore up the finances, to the point where it took the group from a sizable assessment to a over $20 million surplus in 2020. And to your point, our group was able to give back a $7 million return of surplus in December 2022. So to your point, when it was required to be able to shore up the group, but every single member that stayed in the group and paid that assessment, when they did their analysis of what they paid, including the assessment, compared to what they would have paid on the commercial market without having the controls that they have in a self-insured group, they all said that they fared better staying in CRMBC and paying the assessment. And you know that personally because some of those members are your members and you helped do that analysis.
Yeah, correct. And they went through 2 assessments and they're still in the group. And historically, if you look at even with the assessments, had they been in the standard market, they would have paid far more for certain years that they had losses and claims and so forth. But the assessment is really what kept the solvency of the group. If there was no assessment, the CRMBC wouldn't be viable today. And so the members need to understand when you come in that an assessment can be there. But if you are running it and you're watching your expenses, and you, the actuaries get the proper data to calculate what our exposures may be, and that we don't give back too much at a certain time, and that we watch the members we come in the group, that we don't compete with the standard market. So if you do things the way that you would run your own company, I mean, how many companies today, forget SIGs, if you're running your company, how many people are just taking risks, spending money here and there and so forth? No, they don't do that. And when you need to raise capital, what do? You get equity partners. That's the same thing. So all we're doing but we're doing that internally. So when we need more money, we go to the members and say, hey, we're sitting around the pool of money. We're watching the money, but you know what? It's running low. We could, lose a little bit more money. So, hey, we just need everybody to pool a little bit more money so that we can right the ship and get through this process. And then eventually we'll get back to the other end and then the surpluses will come back. So it's a temporary situation, but it's not a bad thing. It's just, it's a solvency issue. But if we're running the ship and we have a great board right now, we've got great CPAs, we've got a great claims team, and when we're watching our expenses, can an assessment happen? Yes, but we try to avoid them at all costs. But hey, they do happen.
And to your point, the things that we have done, that we've instituted over the last couple of years, have really made this an even more secure group. Obviously, we can never guarantee we won't have another assessment, but we can guarantee we won't have assessment for previous lost years because we did 2 lost portfolio transfers up to 2014. So now there's no risk of any assessment for those old accident years because we sold those off. So the things that we put in place, we have a new administrator who actually one of the principals of the administrator is the former chief of OSIP, who actually literally wrote the regs, who is now responsible for making sure that we're in compliance with those same regs. So that's one of the things that we did. I'm the new CEO. I've been on the board for over 12 years, and I came in and I helped lead the turnaround team that turned the group around. We've got an amazing auditor, CPA. Our board is phenomenal. We've got two members who are former board members of the California Restaurant Association. We've got large operators who are very active, very engaged with the governance of the group. And those are the things that we're doing to ensure that that doesn't happen again. But to your point, even when we had to do an assessment, the members that stayed in the group still fared better than they did in the commercial market.
That's correct. And so there's a lot of uncertainty in the insurance market right now. So when the rates do go up, are you going to get a 30% increase? You're going to get a 15%, 50%? Nobody knows. And so at least with a self-insured group, year in and year out, based upon your rate studies, where you are. And so, and what the great thing about that is the board shares that with the membership. So if you're a member that's completely engaged and you really want to control your costs and you're involved in the self-insured group, I mean, you're joining a family of other professional, successful restaurateurs that want to, control their costs as well. And so we're doing this collectively. And so it's not like you're on an island by yourself. And like you said, yes, the regs, OSIP, John is part of the team and he wrote the regs, and they've even made some changes to where there's a lot more steps you have to go through before an assessment has to happen. So they've put some other things in to help improve solvency of self-insured groups. So now is the best time to get into a self-insured group before the market turns. And if you want to take control and improve your bottom line, I can't recommend anything higher than a self-insured group.
Thank you so much, Mike. This was a great topic to tackle. And that's all the time we have for this one, but we will see you on the next video. Thank you all for joining us today.
Thank you, Kaya. Have a great day.